So what is leveraged finance? Well, it's right there in the name. It's when a corporate acquisition is financed using leverage. In other words, it's when a company is bought using debt. And we're not talking about a little bit of debt here. I'm talking about serious amounts of debt, like billions of dollars. Sorry about that. Anyway, pretty much anybody can use leverage finance for an acquisition. A company might use it to buy anything from real estate to a rival, or you might find corporate officers at a company using it to effect a management buyout of the corporation. But probably the most frequent use of leverage finance these days is when a private equity firm uses it to buy a company. So let's focus on that one. And let's meet our private equity player, also called a sponsor. This one's name is Sheila. Now, her firm doesn't usually have that much money to spend, and the company the firm wants to buy could be enormous, like billions of dollars. Now, let's say this business is valued at $10 billion. Sheila's private equity firm can only afford to put up $2.5 billion, which means they need to find $7.5 billion from somewhere. What are they going to do? They're going to borrow that money. And where do you borrow money? From a banker. This is Billy the banker. Now, these days, banks don't lend anything like that kind of money. Instead, they provide certain services. They act as a conduit between the borrower, the private equity firm, and a bunch of other investors who want to lend to the firm. Now, this is called arranging a loan. The bank might also commit to underwrite the loan. This is when it guarantees that the private equity firm is going to get the money it needs, even if the bank has to dig into its own coffers to make that happen. The bank might also commit to arranging a bond issue to go alongside the loan, to increase the variety of investors that are involved. Frankly, anything they can do to get this deal done. Now, Billy the banker gets paid handsomely for providing these services. It's a lot of work, but there's very little risk. Unlike being the actual lender, where there's the risk you might not get paid back, especially when the borrower is carrying a huge amount of debt. Now, that debt is serious baggage, and it's not the private equity firm that has to carry it, it's the company they bought. It now has to do business as usual, carrying $7.5 billion in debt. Now, in a situation like this, bankruptcy is a very real possibility, but if you're willing to take the risk and the company remains good on its obligations throughout the duration of the deal, you stand to make some serious money. And if you invest in the loan part of the deal, well, you're maximizing your protection, which means that you're going to get a relatively small amount of interest. But if you invest in the bonds, you're taking more risk, which means, of course, you're going to get a greater return. Now, it can be years before the private equity firm actually sees any money on a deal like this. And until that happens, it has to operate the company. And that means managing that huge amount of debt. That's a pretty tall order. And sometimes it can lead to some very deep cuts in the company. Sometimes it means selling off some of the company's operations. The plan is to get the company to the point where it can be sold, maybe to the public or maybe to another corporation. So let's say the private equity firm manages to sell this company for $15 billion. Not bad, right? Because they bought it for 10. But unfortunately, $7.5 billion of that dollars goes right out of the door, right? Because it's got to go back to those lenders, leaving a balance of $7.5 billion. Of course, the good news is that that $7.5 billion belongs entirely to the private equity firm. So what's happened? The private equity firm has managed to turn a $2.5 billion investment into $7.5 billion. That's a 300% return on investment. So it's no wonder that private equity firms are so willing to take this kind of risk. And there is a risk, because if they fail to return that $7.5 billion that they borrowed to the lenders take possession of the company. And that includes the $2.5 billion initial investment made by the private equity firm. And if that happens, it's going to leave our private equity pals very badly, needing a drink.